and a warm welcome to this quarterly update from SKAGEN Global. Today we are going to talk about how the fund performed the second quarter this year and what threats and possibilities we see going forward. And to answer those questions, I've got portfolio manager Søren Christensen with me in the studio. First of all, Søren, how would you describe the fund's performance this quarter?
Well, I mean, I think if you look at the overall numbers, it looks like it was a fairly boring and uneventful quarter, right? I mean, it's more or less flat, both for our fund and index, down slightly. But I mean, underneath there, you had fairly large volatility within the quarter, and also among the individual markets, you had a huge discrepancies in terms of returns.
We are going to talk a bit more about this probably, but there has been a gap expanding between the developed markets and the emerging markets. How has that affected SKAGEN Global?
Well, I mean, there's no doubt that if you compare sort of the composition of our fund compared to the index, we have a lot less in the US than the index has, and we have a lot more in emerging markets than the US has. So that historically that has hurt us. And say in this quarter, the difference between our return and the benchmark was fairly narrow, despite actually the emerging market underperforming very significantly. And the reason for that is that I think a lot of our underlying companies actually did a lot better than the country that they're based in.
All right, let's have a look at your slides.
Yeah.
Starting with the market.
Yeah. No, I think, as I said, I mean, the only reason why the global market was more or less flat is exactly because the US market continued to do very well. So to a large extent, it's driven by the fact that sort of on the margin, the place in the world economy where you're seeing sort of positive surprises continues to be the US economy, especially the housing market and the employment market. And then on the other hand, you saw a sign of stress in quite a few emerging markets. Most particularly, obviously, some of the losers that we see on the slide here, Brazil. We see signs that inflation is getting out of control. You're starting to see signs of political and social unrest. And of course, with long-term interest rates moving up, that had, aside from equity investors pulling out, a lot of fixed income investors pulling out. So on top of falling equity prices, you had the currency moving against you. And you had a very similar picture in Turkey. Not as bad as in Brazil, but some of the same factors playing in there, particularly obviously as everyone probably is aware of the social unrest and people pulling money out, really hurting the currency as well.
And how large is the exposure to Brazil in SKAGEN Global?
Well, in Brazil, we have a few positions. It's not a very big market for us. Turkey, we have also have a few positions, but I would say on average, our positions did relatively well compared to the Brazilian and Turkish market. But clearly, if you look at the winners and losers in our fund, it also reflects sort of the development you saw in the overall market.
All right, moving forward.
Yeah. Yeah, I mean, and exactly as I said here, I mean, if you look at the winners and losers in our fund, it is very much a reflection of what you saw in the overall market. So on the winning side, you almost entirely have US companies, and on the losing side, obviously a lot of emerging market companies. And I mean, if you want to go into a bit more detail, we have Citi here on the winning side, and they just continued the sort of process towards normalization, if you can call it. So continue to reduce the asset in the bad bank. And that obviously means that we're getting closer to a situation where Citi can start to buy back their own shares aggressively, because as you reduce your bad assets, you will release capital tied towards those assets. On top of that, you have seen obviously an improving US housing market having a very positive effect on credit cost in Citigroup. Another position is Microsoft. It's been unpopular for a long time. We've waited for a long time, but we finally got paid this quarter. And I think the main reason why Microsoft has been very unpopular is because of the very weak PC sales we've seen, and people sort of link that to the death of Microsoft more or less. And there's no doubt declining PC sales is not positive for Microsoft, but I think the market has missed the point that The enterprise segment is much more important for Microsoft. They continue to do very well there. And also I think we're seeing increased signs that in this transformation towards cloud, if you look at the established tech companies, Microsoft clearly stand out as one of the few that have handled that process extremely well. And maybe last, just worth mentioning the US insurance company, AIG, very similar story as in Citi, was bailed out by the US government during the financial crisis. And since then, they've started a normalization process, continued to sell non-core assets, and now more and more shifting the focus towards improving underlying operations. So things there again clearly moving in the right direction.
Very well. All right, on the losing or negative side.
Yeah, I mean, clearly you had a lot of emerging markets names there. So you have Gazprom, of course, when people pull money out of emerging market and particularly pull money out of Russia, you are of course seeing the largest stock in Russia getting hurt. On top of that, on the company side, they did come with a negative surprise in terms of their dividend. They cut the dividend more than we expected and more than the market expected. So that was clearly not a positive development. Otherwise, you have, as we mentioned, Brazil, so Banrisul, Eletrobras, very much driven by a weak market in general in Brazil. And then you have one US company, ADT, a home alarm business that was spun out of our investment in Tyco. The case here is very much reliant on the company continuing to produce very strong cash flow. And there were some analysts and some in the market that started to question the sustainability of that cash flow. But we're still very confident with the case, and we think that the reason why you're seeing some short-term weakness in the cash flow is because as they grow, they subsidize their clients upfront, but they get paid for that over the life of the contract of that client. So we feel that the weakness you see in cash flow is simply just because they're growing at the moment, and we don't see that as changing the fundamental story behind ADT.
All right, and the fundamental story with the backdrop of an improving housing market in US.
Yeah, so that would clearly also have a positive effect on ADT.
Very well. Okay, let's have a look at the next slide.
Yeah. So I mean, if you look at what we did over the quarter, I mentioned Russia was weak. It was particularly one point during the quarter that Russia was extremely weak, and we used that opportunity to pick up some more Sberbank, the largest bank in Russia. I mean, we own the pref shares. We're buying that at book value. We are owning a bank that produces on return on equity of 24%. We're getting paid a dividend yield of 5%. It's a very liquid bank, has a very healthy balance sheet. So we feel very confident with that case, and the overall market weakness gave us an opportunity to pick up some more at attractive prices.
Mm-hmm. It's interesting though that finance is picking up so well.
Yeah, but that's very particular to the US market, I would say, and particularly because you are seeing an improvement in the US housing market. I think if you look at emerging markets, I mean, financials didn't do particularly well in this environment. And that was one of the reasons why, for instance, we initiated a new position in State Bank of India. So I think last quarter when I was on SKAGEN TV, I said that because of the fall that we had already seen at that point in emerging market, we were starting to see value emerge in some of the emerging markets that we haven't previously been very exposed to. Mm-hmm. A good example is India. Historically, that has been a very expensive market, so we've struggled to find value there. But as we've had a fairly large correction, we're starting to see some individual opportunities. So we invested in the largest bank in India. They're obviously being hurt short term by fairly elevated credit cost, but we feel that is a cyclical factor, not structural factors. So we feel as the economy improves, those credit costs will come back down, and that will have a fairly large positive impact on the earnings of the bank. Mm-hmm. And of course, structurally and long term, there's still immense growth opportunity for a bank like State Bank of India.
Mm-hmm. And you also, I can see, bought into Nordea, Scandinavian Bank.
Yeah. We did that in the process where the Swedish government sold down their stake. And I would say the case for Nordea is very much the same as you see in some of the US banks that we bought into. I mean, they didn't struggle to the same extent as the US banks did. But if you look at Nordea specifically, I mean, they have very strong position in every market in the Nordic region. They are already, at this point in time, very profitable. They are already well reserved in terms of the balance sheet. We see credit costs coming off, particularly in Denmark. And sort of in that scenario, we see a huge scope for Nordea being much more aggressive in paying out dividends. So we expect dividends to go up quite dramatically over the next few years in Nordea.
Very well. All right. On the selling side.
Yeah, I mean, it's, I think, very much a continuation of what we have done over the past year, basically. So we talked about many times that where you've really seen a revaluation of valuation multiples has been among these stable companies. So Pfizer is one example. We've seen a tremendous development, earnings multiples expanding rapidly, and we're now completely out of Pfizer. SCA in Sweden, same story here, valuation multiples really growing and see less upside, so continue to sell. Gjensidige, the same thing, very much. I mean, they have done well operationally, all of these companies, but on top of that, you have seen sort of an increased popularity in the market, and that means that valuation multiples have expanded.
Okay, next slide.
Yeah, I mean, there's not too much to say here. We've shown that a number of times. As always, I mean, what we are concerned about is the overall valuation of our fund. And as you can see here, both the top 10 and top 35 names trade at what we see as very attractive multiples on an absolute basis, and trading at fairly massive discounts to the market. So we're still very confident that we'll be able to deliver both a strong absolute and relative return going forward.
Very well. Okay. You have brought a company case, haven't you?
Yeah.
Phillips.
Yeah. It's one of the new investments we made in the quarter. I think when most people think about Philips, probably think about mobile phones, where they weren't particularly successful. Probably think about flat screen TVs, where they weren't particularly successful. And they might think about semiconductors, where they weren't particularly successful. So, I mean, they historically been very exposed to businesses that was very commoditized, where they were facing pressure from low-cost producers in Asia, and they generally lost out in that competition. You can say in all these areas, they lost out to Samsung. So, I mean, we've been following Philips from the other side of the table for many years. But I think that the market is really missing that huge change we've seen in Philips over the past 10 years. So if you look at the revenue base in 2000, almost 2/3 of that has completely gone. I mean, they've spun out, sold or exited businesses. So what we're left with now is a very different company. It's a company involved in attractive industries, and I think the management has been fairly successful in changing the culture at Philips. So if you look at Philips today, they have 3 main businesses. First is healthcare, so they do machines that do X-ray, ultrasound, MRI scanners, etc. This is not a business where you win by producing at the lowest cost. It's a business where you win because you are innovative, you have a strong brand, you have good connections with your clients, and it's an industry where there are few competitors, and those competitors behave rational. So a very healthy industry. Then you have lighting. Of course, here traditional lighting is of course being pressured by the shift to LED. But I think Philips has done a good job. They saw this transformation many years ago, so they were clearly ahead of the curve in terms of reducing cost, reducing production footprint, and that means that even in this process of the market where you see a shrinking market, Philips is actually fairly profitable. When it comes to LED, I think they've done a good job. They're clearly at the forefront, and I think they really understood where the value of this industry is going to lie in the future. So limited exposure to upstream or production of LEDs, which I think is going to look very much like the semiconductor industry. And then on the other hand, focusing on having strong distribution, having strong relationship with clients, having strong focus on solutions for clients, and I think they've come a long way and been very successful in that. And then lastly, consumer lifestyle, so kitchen appliances. Maybe people might not know, but they have half the world market in shaving. They have very high market share in electric toothbrushes. So again, here fairly attractive businesses. They have a particularly strong position in emerging markets. So we feel that again a fairly attractive business. So overall, I mean, Philips is a very different company, attractive underlying businesses. That is clearly not reflected in the valuation you see today. We still think that despite having being cost-cutting mode for multiple years, they can still take out costs because Philips was simply just so mismanaged historically. And on top of that, they already have a healthy balance sheet. So we think that in the future they will be more aggressive in buying back shares on top of a already fairly attractive dividend yield.
So very interesting. Let's have a look ahead and talk a bit about what, in your view, will mark this months ahead. What trends? What do you see as the most important trends going forward?
Yeah, no, I think we're clearly still in an environment with high degree of uncertainty, particularly, of course, in Europe. And I mean, you saw just last week. I mean, the situation in Europe flaring up a bit again. So I think that is going to continue to play an effect on the markets. The other big question is, of course, China. And you've seen some signs there of perhaps stress in the financial system. So I think that's going to be another sort of very important factor that's going to drive the market in the short term. And then the last thing is clearly going to be long-term interest rates and how that is going to impact the market overall, but particularly individual companies, particularly companies that maybe have too high leverage. Because you see, we've been through a period now of many years where interest rates have been very low. A lot of companies have used that opportunity to lever up their balance sheet, and you want to make sure that now you're invested in companies that have done that the right way. So sort of secured long-term fixed financing, not been hugely leveraged on short-term financing that could pose some real challenges. But I would say overall still, if you look at the market, valuation multiples, they don't look stretched. Underneath there, as we've said many times before, the stable companies continue to look extremely expensive. And I think it was pretty interesting to see the last sell-off we had. Actually, a lot of the stable companies, they sold off as violently as some of the cyclical names. And I think that is an indication that there are a lot of investors in these safe and stable companies that perhaps don't realize that given the valuation of those assets, it is no longer safe companies. The stock price is no longer safe, right? So I think we are starting to see more and more evidence that people are realizing that the valuation is looking very stretched there.
All right, so you're just waiting to get right there.
Yeah. No, I mean, we still feel very, very confident that sort of underlying we have the right companies.
Very well. All right, let's flip to the last slide, because I want to just let you all know that in a few days we'll be publishing our latest market report. So if you're curious as to SKAGEN Global, what they are doing, or our other funds, you can have a long and thorough read. Otherwise, don't hesitate to call us or contact us if you have any further questions. In the meantime, thank you so much for watching. Have a great summer.